So first of all, I'd like to thank you all for investing your time with us today, because time is our most valuable asset. So first of all, I'd like to introduce the infamous, the famous Mr. Shawn P.E. Flynn.
Joe, thank you for giving all my middle initials to everyone. A little bit of my background is I lived overseas for about 8 years. A lot of that time was in China, started some companies. One did pretty good, came back to the U.S., invested my time with startups. Currently, I am principal at Global Capital Markets, a mid-market investment bank. When I'm not working with them, I have a podcast, an award-winning podcast, which throughout today we might hint at someone that's going to be on the show for next week on Wednesday, and we'll drop a link to subscribe. You'll want to check out that episode. A lot of great information. And I'm also a mentor at the Mentoring Club, where I help mentees around the world. So I'm excited to be here, and I'm excited to be here with this gentleman here, Joe, no middle name, last name.
Thank you, Shawn. Shawn, I know you spent a lot of time overseas, so could you say something in Chinese just to kind of kick things off a little bit?
大家好，我很高兴你们都来今天看我们聊天，我们在这，我们希望教你很多东西，谢谢你们，谢谢你们。
I was just thinking the same thing.
Exactly. Wait, Joe, do you know anything in Korean that you can say?
안녕하세요.
Oh, whoa.
한국 한국말 하세요?
I was thinking that.
I just said, see? So, Joe Siecinski, some of you know me. I am a business coach. I help businesses get prepared to talk to Shawn. And we're going to talk a little bit today about how to build a business, and then when to engage an investment banker versus a business broker, and some other specific things. And this is interactive. So as we're going through this, please feel free to come off of mute and ask questions. The more interactive it is, the more knowledge we gain, and the better the event is.
Yes,
Sound
I
good?
agree.
So thank you all very much for being here. So Shawn, as we start building the business, people say, what's the difference between a business broker and an investment banker? So maybe we could do a poll to see what people think.
Are they the same? Are they different?
That's a good question. So what do we think? Are business brokers and investment bankers the same, or they're different? Oh, look. We've got some results.
All right.
Okay, let's go ahead and end the polling. And 100% say they are different.
Oh, you got a very smart audience.
We do have a very smart audience. This is a sophisticated audience. So, Shawn, what's a little bit of the difference between a business banker and an investment, or a business broker and an investment banker? Yeah, I see. I
mean, there's a lot of differences, but there are some similarities. First off, they're all very useful, all very helpful in their own ways, in their own niche. So business brokers, they usually work with Main Street businesses, coffee shops, mom and pop restaurants, normally one location where you have an owner there working day and night in the business, and then the new buyer is normally someone local that's either buying kind of a job, replacing that current owner with themselves. It's just normally a little bit of smaller scale, where that business broker will come in. The way they market it is putting on some websites. They wait for buyers to come to them, or if they have a buyer's list to go out. And think of it more as that local real estate agent. And a lot of business brokers, they work off of a real estate license, especially here in California, where they're allowed to do asset sales and that. There's a lot of things that they're able to do. But it's normally, like I said, that one location. Normally it's under $5 million. Most of these transactions are 150, 300, maybe up to $1 million. So think that kind of niche. Investment banker, though, different beast. FINRA regulated, lots of licenses, lots of compliance, lots of, have to do it this way, that way. Normally there's a team that comes in on the deal. So it's not one individual working with you to sell your business. There's a team, 4 or 5 experts that come in, package it, look out for the investors or buyers. And these people aren't that guy that lives down the street. These are investors, private equity groups, sovereign wealth funds, family offices. They could be anywhere in the world, because the business at that point that the investment bankers come in, they normally run themselves. They have a team in place, they have processes, they have a lot of things that we're going to talk about. But so think of it this way: business broker, this right here, investment banker here, but all are important.
Kind of Main Street for business brokers. You hit that 10 million space and up, then you're looking at investment bankers. Probably not JP Morgan, but
mid-market, lower mid-market, maybe, uppers, you're looking at 500 million, something like that. But that mid-market where we work, 10 to 200 million, 10 to 250 million, that's when the investment bankers come in, because it's a different buyer, different investor with them.
Well, and you do a lot more work going out and looking for those specific type of investors or money, depending on what your goals are.
Oh gosh, we can talk about the whole process later, but it's not just putting stuff on a website. That's for sure.
That's true. So let's talk about how to get the business built so that we can engage you. Okay. So when you build a business, it's kind of like building a house. When you build a house, what do you start with?
Land.
That's good. And then what's the next step? Maybe
foundation,
or maybe even a blueprint, and then the foundation. So this is the blueprint, and this is the foundation. So when we start, and you start looking at, okay, what do I want to do? What is my business going to look like? We got to have our ultimate goal. So what do you want the business to look like when you sell it, or when you IPO, or are you building an apartment complex, multiple apartment complexes, or a mobile home? It's all okay. It's your goal, nobody else's. But defining that allows you to start building this. And then time. It's your most valuable asset. So how you utilize your time will determine the success of your life and your business. And by the way, there's a great book. You might have heard of this, brainSHARE, available on Amazon and Barnes & Noble. If you haven't got a copy, do so today. And I'm sure we'll send out a link for that as a follow-up.
I got the digital and physical copy of this book. And because I have it on Kindle, I keep it in my pocket at all times.
And this really gets into how to leverage your time and utilize it effectively. And then the third cornerstone of the foundation is standards. Standards is all about consistency in your product or service. So who makes more hamburgers than anybody in the world?
I think McDonald's?
I would say McDonald's. Are they the best?
Oh God, no.
You don't like McDonald's?
Well, if I'm in a emerging country and I'm starving, I'm just not sure because I don't speak the local language, but I see those golden arches, I know what I'm going to get.
You know what you're going to get, and you know about how much you're going to pay for it. So that's all about standards, consistency in your product or service, and then finances. Is finance important when they look at, looking at exiting or getting investment money or mergers or anything?
Well, to be honest, let's say you want to sell your business for $20 million. All you have to do is tell the person we're a good company, and that's it. They trust you.
For $20 million, here's the check.
Everything's done on a handshake, honesty policy. That's how it is. If you want to look at past year's financials, the balance sheet, the profit loss, the income statement, I guess you could, but that's kind of an overkill, don't you think, Joe?
Well, especially when you have to go back 3 years and look at your financials, and
what a bother.
Yeah, it's only $20 million.
Yeah, but for some of those sticklers, yes, they will look at your past financials. They'll want to make sure that maybe an audit was done. It depends on the size of the business and that. But yeah, they'll look back at your financials, past 3 years, maybe even 5 years they'll want. And the financials tie into everything else because they're not even going to look at the past. They're going to look at the future, those pro formas, what you think the company's going to do, how it's going to grow. And they're going to look at it, past, present, future, and make sure that story, is believable, consistent, that there's some substance to it.
Well, why do they want to know that? It's not like if you give $20 million, you want to get money back.
Wait
a minute, it's an investment. So if they're giving $20 million, they probably want to get more than $20 million back.
Joe, I think you're onto something here.
I think I might be.
You're going to revolutionize the economy.
We'll see what happens. But your finances are like your report card. You've got to know them. You've got to be running them on a regular basis. You got to dive into not only your financials, but your operating things. How many leads do you need to get? What's your conversion rate, average dollar sale, number of transactions, your gross margin, your net margin, your break-even point as it evolves. Your financials are your report card, and you've got to be running those. Now, that's the foundation. That's every business has to have that. And then we move into market positioning. This is where you start trying to get stable. Your unique selling proposition, the most important, your target market. Because that tighter that target market, it's like a magnifying glass. If you walk outside, you might get a little sunburn today. But if you take a magnifying glass out there, you can catch your foot on fire. And you can actually, you want your business to be hot. And the tighter that target market, the hotter the business. So unique target market, unique selling proposition, guarantee. This is where you put your strategic, your tactical marketing plans together. Strategic is having multiple marketing strategies in place. No more than 10% of your revenue should come from any single marketing strategy. Otherwise, your business is at risk.
Wait, you're just trying to say that I shouldn't have one customer be my only customer?
You could do that. It's your business. However, I've had multiple clients over the last 11 years that have had one or two clients, and when things change, they end up not having a business, and that's not a good thing.
Learning lessons from others.
Yes. So that strategic marketing plan, your tactical marketing plan, who does what by when. This is also when you put your sales training together, because depending on your business, you're going to need different sales strategies and sales training. So now we've got the sales going, we've got our marketing going, and everything starts stabilizing pretty good. Now, the next thing is, how do we systemize that? Let's save yourself time, energy, and money.
I can remember that.
That's how I can remember it. Is I use the little thing. This is when we start systemizing everything, and this is when the valuation starts increasing because we're not dependent on someone's knowledge. We have the processes and systems in place, and I mean everything from your marketing systems, your sales systems, your sales dashboard, your sales processes, your operational processes, your operational reporting, your accounting functions, your bookkeeping, your legal, your HR. Everything gets systemized. And that's when things get stable, and not only stable, but repeatable. Because now that you got systems, you can actually take your business and start duplicating it. Oh, but we got to make sure we got the right team in place. Mm-hmm. So, org charts, roles and responsibilities, KPIs, the right person in the right seat at the right time, on the right bus, going to the right place. And then now we're really, based on our goals, start going, oh, I want to expand. I need some money. What do I do?
Well, in a case like that, depending on where your company is, there's many different types of funding strategies and many types of people, organizations, groups to go out and get that funding from. So depending on where you're at, I mean, you might want to talk to an investment banker about your funding strategy.
Do you know any investment bankers?
Sarah, could you give everyone information on one at the end of this call?
I think there's a guy named Shawn Flynn.
Hey.
Just Google it, but sure.
And I forgot to introduce Sarah. I am so sorry. Sarah is our IT guru, helping keeping this thing running. Sarah, I apologize sincerely.
Don't worry about it. I'm just behind the stage. It's fine. Keep going.
Sarah keeps me on track with everything. So, Sarah, thank you so much for everything you do. You are awesome. And so, an investment banker, we want to expand.
Yes.
So we talk to them. What about if we want to exit?
Same thing. I mean, talk to the investment banker very early, or maybe a business broker, depending on the size of your company. If you worked with Joe and it's that size that maybe fits that mid-market, maybe an investment banker is more of the fit for you. But talk to them early, and they're going to go through the team, the systems, the position, everything to kind of tell that story to the investors, depending on, like I said, who the investors are going out to. In some situations, you might go out to venture capitalists. Some situations, private equity. Some groups, or some situations, strategic buyers. So it all depends, maybe family offices too, on that exit, where you're at, what your company's doing, the position in, to determine who's the right fit or the most probable acquirer for what you're doing.
Well, what happens if maybe you don't want to necessarily sell, and you're not sure? Maybe you just want to kind of take some money off the table.
That's another thing. Say you want to sell off 60% of your company. You've been at this company for 20 years, 30 years. all your equity, everything is in this company. You've spent your life building it.
Right.
You're thinking, I'm kind of close to retirement. Maybe I should put a little bit of money here, a little bit of money there, but I don't have it because it's all in this business. Well, an investment banker can come in. They can sell a percentage of your company, maybe to other investors, a family office, high net worth individual. There's a lot of different possibilities, and you can take that money and diversify. Recap your debt structure. There's a lot of things that you have a lot of options, and a lot of people don't know they have options until they have a conversation. And then once they have a conversation, they see the options that they have.
And then maybe you want to bring into a financial advisor to help with that dialogue.
Oh God, early, especially for taxes. That's one thing that a lot of people don't prepare ahead of time for these events, these exit events, for this increase in capital is the taxes. And I'm not a tax expert, but that's something maybe we bring in another expert another day.
And we both have resources in our network to bring in. So that is definitely critical. Well, what about if you're, how about a merger? How would you handle that?
It's very similar. The process itself to get acquired or even raising capital, there's similar processes. And actually, Joe, if you're open, I could talk a little bit about the process, or if you're up to another question time or process time.
You know what? Before we go to the process time, how long would it take to do that? Sarah, can we do a poll? Number 3. So how long do you think it's going to take to, on the average, to get funding or to sell, do something with an investment banker? Can you do that? Thank you. We had a good duet there. All right, fantastic. Let's share the results. So 80% of you said 6 months. So Shawn, what do you think about that?
I think that's right. I mean, on average, it's 6 to 9 months for these transactions, whether it's getting funding, whether it's getting acquired. And the reason why is just the process itself. There's a lot to it. I mean, a lot of people will say, hey, I want this money by the end of the month. Good luck. Hey, I want to sell my company soon before the holidays. Good luck with that. And the reason for it is, there's so many steps. So, for example, normally the first month is just collecting the information from the owner of the company so that we're able to know about it ourselves. We're able to create the marketing material.
Well, they can just give you their financials. Isn't that all you need?
Well, the financials is just one part of the data room, one part of what's going to be needed later for due diligence.
What do you mean the data room? What's that?
Well, the data room has all the information on the company itself. And we're talking about, articles of incorporation. We're talking about contracts, employment contracts. We're talking about, yes, the financials.
Well, wait a minute, you said contracts. What kind of contracts?
Well, you might have some contracts with your vendors. You might have contracts with your buyers. Maybe you have a product.
You mean company contracts that you have with vendors or suppliers or other? I never thought. Yeah.
Your lease on your building, that's a contract, is it not?
That is a contract.
Is that transferable? How much longer is on it? Is it under market rate? Is there value there? What's the step up? You have to look at all this.
You have to look at your building, and if you own the building or maybe you don't own the building, is that included in the? Oh, there's a lot more to that.
There is a lot there.
Okay, so you got your financials, your contracts. What else will we have to look at?
Well, think of the due diligence again broken down into 4 sectors.
Okay.
Or 4 sections. You have your business, all right? So articles of corporation, you have your org chart, your structure, all your team players, everyone, their background, everything.
Oh, you mean you have to talk about the background of your team?
Well, I kind of want to know that CTO has done something in the past that might warn him to be in the position he is in right now.
Oh.
I need to have confidence that he's able to do his job. I need to have confidence in the sales guy, the marketer, all these people up here and the team. I need to have confidence that they're able to not only do what they're doing now, but even take it up a level.
Oh, well, so we're not just going to write that $20 million check.
Oh, Joe, I was joking at the beginning there.
Okay, so now we look at the people. You've got the people aspect, their backgrounds, what they do, what they've done, and whether they're going to evolve with the company or not. Is that in there too?
So that's business due diligence, right?
Okay.
We have legal. So have there been any lawsuits in the past? Are there anything pending? Are there any threats for future, litigation? Are all the contracts, going back to contracts, up to snuff? Are the employment contracts? So you have.
You mean even like wrongful termination suits or?
Well, I mean, let's just say if I were to fire you over drinks, it might come back to haunt us later.
Okay. So everything is going to get looked at in that whole contract, in that whole space.
Everything. And you have technology due diligence too.
Okay.
Most people, I mean, they don't think about this, but guess what? Right now, cybersecurity is a big issue. Do you have cybersecurity insurance? Is all your tech up to date, or are you using legacy software? Are you using legacy applications? Is your stuff in the cloud, on-prem? All that stuff people want to know about your company. And if your stuff's not up to date, that actually could drag your valuation down. If it's not secure, it could drag things. There's things at play there that people are going to ask.
So what about patents and IP, other IP? How does that get looked at?
Legal due diligence, they want to look at it. I mean, does your patent wheel, and what I mean by patent wheel is, are you not, you could protect the technology, but you can also have patents that protect the business, how that functions. Are you protecting what you're doing with your strategy, with your patent strategy? Are these patents pending? Have they been issued? There's a lot to that too. And people in our network, we do have patent lawyers, we do have patent strategy experts that we can refer people to, but all that comes into play again in the due diligence.
Oh, so you just don't do that by yourself?
Well, the thing is with this is there's so many experts that are needed for this process. It's another reason why it's not just done in a day.
Right.
It takes all these months because you'll have this expert come in, give their thoughts and opinions. This expert come in, thoughts and opinions. You'll have all these people providing their expertise so that it goes smoothly during the process and after. We don't want 6 months down the line then we go, hey, wait a second here. You didn't disclose everything, or what we thought wasn't what was there, or there could be a lot, and no one wants litigation.
Oh, the lawyers
Except
do.
the lawyers.
Yeah, I was going to say, the lawyers like that litigation. That's how they make their money. Okay, so we got business.
We have business, we got technology, we have legal, and then we have accounting. And accounting goes back to this finance.
Okay.
And those are the different areas of due diligence, if you were to break it down into 4 areas. But that's due diligence, that's the data room. We haven't even gone out to market. I mean, we were just collecting information to create the marketing material to then go out to market for this opportunity.
You mean you just don't put this together and people just don't flock to buy the business?
Well, I mean, on an occasion you'll be on Shark Tank, and you know how that all stuff. But in reality, a lot of people don't know. They think, it's in Silicon Valley, you just go to Starbucks and then that's it. But in reality, you'll take this information, you'll have your one-pager, your executive summary, and your SIM, which is your confidential information memorandum, which will be given after, and normally an NDA is signed, that has a lot of information on the company, not as thorough as the data room, for due diligence, but enough that they're able to make a pretty good guess.
Before you even start selling that, you've got to have the data room, but you said something else, the NDA. You mean there's something happens before that?
Yeah, I mean, when we go out to market, say we go out to 1,000 potential investors or buyers, and we're not going out to strangers. We're going out to people whose investment thesis fits that company we're working with. And the investment thesis would be, we write this size check to this geographic area, this sector, this stage, all these things. So we've done research through our either past 30 years that the bank's been around that I'm at, through online databases, through connections, to make sure that the ones we go out to are the ones that would be most interested in this opportunity. And we send it to them. Now, we don't give them all the information on day one. We give them just enough for them to be curious about. And then if they're curious, they ask for more. And we give them a little bit more. And then after that, if they're more curious, we give them more. But I think we have a question from the audience.
Yes. So this is pretty interesting, guys. So, Shawn, in your experience in working with businesses that are deciding that they want to look for this investment or sell, what percentage of them actually understand the kind of level of thoroughness that you're describing that they're going to have to go through?
On their first time, 0. Maybe 2%. I don't know. But it's literally close to nothing if it's their first time. Now, everyone, after they've done it once, they know the process. They're not surprised. They have all this information ready even before they come and talk to us, because they don't want to spend any time or money that first month collecting it, going back and forth. You know, we need a high-res logo from you for the sim. We need your financials. We need all this stuff.
Right.
First time they have that conversation, I've not come across anyone yet that really understands how thorough and how lengthy the process is. But as you explain it, as you start going through it, it makes sense to them. And
Sure.
But yeah.
So then, of those first timers, what percentage of them actually throw up their hands and say, "This isn't worth it. I'm going to just forget about it"? Or do they really? Are they serious enough to put in the effort to get the information together?
Well, we would sign an engagement before actually getting any of the information from them. It's normally that first month, and that first month we're screening them as they're screening us. So what I mean by that is most investment bankers, they work on a retainer and a success, where that success is the majority of the money they take in. You know, for us, it's like 85-90% of the money we make is off that success. So we only work with someone that we feel confident we'll be able to get that end result with. So there's quite a few that come to us that we say no to.
Mm-hmm.
Then we go, listen, what you're expecting and what our initial research in the market is telling us are way out of whack. It's not worth us working. Maybe you want $200 million for your company and the market is saying it's only worth 20. We're so far apart that it just doesn't make sense, because when we bring you offers, you're going to say no. It's not gonna work. Or you need to talk to Joe for the next year or two and go from here to here, and then we can work with you. And Joe will help you with the processes. He'll get everything in order for us. But yeah, we really, maybe every 10 that comes to us that actually says, yes, we want to pay this retainer, out of those 10, maybe we'll take 1. But before those 10, you'll get 50, 60 that'll be like, yeah, I want to raise money, or I want to sell my company. But once you actually start talking to them, the conversation goes.
And then, Joe, on your side, what percentage of the clients that you serve put out that they're interested? I think I want to get money, or I want to sell my business, or I want to do an acquisition or a merger. I mean, how many of the clients that you're working with are starting with that then you have to sort of give them that dose of reality?
Well, we almost always start with, what do you want to accomplish with your business? What is your ultimate goal? And it's usually a lot shorter than, hey, I want to get to 2 million. Well, what do you want to do then? Well, I want to sell it. Okay. That's more in the Main Street type business.
Business broker.
But what I've seen is they get to 2 million. They're like, oh, I'd like to get to 5. Ooh, I got to 5. How do I get to 10? Oh, now I start really evaluating other exit strategies on, ESOP is another one, or IPO, which right now the cost for IPOs are just crazily expensive.
We can always go to Jamaica.
We could go to Jamaica. I like that.
You got to think, there's a lot of markets in the world.
There's a lot of markets.
Cool. Thank you.
So David, that's one of the things that we have to start with, because if I don't know where you want to go, we can't put a map to get there. And that's one of the critical things. And is that map leading to Shawn? The ones that I've been involved with over the last 11 years that have gone to the investment banker space and start putting that together, it is a extremely difficult, thorough, and painful the first time process, because you've never been through it. It's like anything.
Yeah, I mean, it's like pulling teeth. I mean, we are finding everything out about the business, because, as mentioned before, we don't want any surprises at any time in this process. We don't want any surprises even after. We want to make sure it's nice and clean, can move smoothly, and everyone wins.
So, if you kind of talked about that end process. When should somebody be talking to you? What's that very first thing is? I know when they're talking to me, I know how to kind of build them and get them there. But if they're not talking to a coach or someone mentor, when should they be calling you?
I always tell people sooner the better, but in reality, there is a too soon. If they just have an idea, that's way too soon. Talk to Joe.
Yes. I've got one of those this afternoon.
When the best time to talk to me is a year before you want one of these exits, whether it's selling your company, whether it's raising capital, or a year even if you want to buy a company. A year before that date, that's ideal. So there's 6 months to kind of prepare, and then 6 months to actually take action. And then we also do that around the calendar as well, because there's some months, December, nothing's really going to happen there. August, a lot of people are traveling, things are kind of slow. So there's a strategy. I'm going to
inject here a little bit.
Sorry.
No, because before you even get to that space, building it takes usually at least 18 months.
Wait, are you saying here to here? Maybe if you're a tech SaaS company in a hot sector, I'd say 3-5 years.
3 to 5 years is not unusual and normal, but minimum 18 months. And that's if you've got something that's red hot that you can go fast on. Well, and you've read a bunch of these books that we've talked about.
Well, there have been people I've known in the past that have done it, exited in 6 months, based purely on tech plays. Okay, they had the tech, they had the patents around it, they had an unsolicited offer come in and go, we like what you're doing, we want to give you an offer, and then they go, whoa, I don't know if this offer is good or not, let's get an investment banker in here and run a process.
Oh, you mean they shouldn't just take the offer as soon as they get one?
Actually, if you have an unsolicited offer, that's a perfect opportunity to talk to an investment banker. 20% of the mergers and acquisitions we do, they already have an offer in their hands from an unsolicited buyer, and they go, we don't know if this is a good offer or not. Can you run a process? Can you take it out to market, get some other bidders, some competition there, so we can feel it out, see if it was a good offer or not? And almost in all cases, they'll get 20, sometimes up to 40% more by running an open market process than just that one unsolicited offer.
Wow, I didn't even think about that. So you're building the business. If they're not ready to come to you, we help build it. And then when they're ready, depending on their exit strategy, and you've got lots of different strategies that we could engage.
Yes, it all goes back. Some people think that this is what they want, but after having that conversation, it's actually maybe a la carte, maybe a little bit over here, maybe a little bit over there. There's a lot of possibilities. Sometimes it's, you might want to sell, but really maybe hold on to it for another year or two, because if you get certain numbers, just increase this much, that exit increases this much just because of multiples.
What do you mean multiples? So what influences multiples?
Well, there's a lot. Your EBITDA, maybe you switch vendors and you get your products for a little bit cheaper. Maybe your overhead goes down. Maybe you're more efficient in this area of your business, but you're increasing that revenue in and that EBITDA there. You bring up EBITDA just a little bit, your multiples can go up a lot.
Oh, so that your EBITDA could be tied to your multiples too.
And Joe, what does EBITDA stand for our audience?
Earnings before interest, taxes, depreciation,
amortization. And actually now there are people saying EBITDA. The C is for COVID. And what people are doing now is they're taking, well, if COVID was a good year, everything is great and we keep that. If COVID was a bad year, well, let's average that for the 3 years before, the 4 years before, and let's play around the numbers and let's see. So there's discussion around that, and they're adding a little C to it.
Interesting.
Yeah.
So you mean it's just not here's a number, that's it?
No. It's here's a number, here are other numbers, here's what we think of the future, and let's do a lot of different scenarios. So you got discounted cash flows. We have or other transactions you compare it to. You have what's the market saying. There's a lot of different things that you can use in your valuation of this company, but ultimately it is what the market decides. It's what that end buyer, that end investor, it's what they put in. that's the final. But you can have a pretty good guess even before that, based on all this other information out there. And we got another question from the audience.
Yeah, I was wondering, with the boomer generation reaching those levels of transition, are you seeing an increase in activity of companies that are in that mid-market area, mid-space area, trying to find solutions, exits?
The conversations, at least I've been having lately, hasn't been so much I'm at that age I want to retire. It's, hey, I'm kind of concerned that this next year there's going to be a lot of tax changes.
Oh yeah.
And I'm kind of looking, how should I position myself so that I don't need to give so much to Uncle Sam? And there's ways to strategize an exit, deferred payments, or there's ways to do that. But that's the conversation period. Hey, should I exit now? Should I start that plan for the next 6 months? Should I grow my business a little? I haven't really been having those conversations of, I want to retire, I want to pass it on. I've had more of the conversations. I'm more concerned about the unknown with taxes. But I'm going to refer to Joe. Joe, what conversations are you having lately?
I'm starting to see more and more of that, but that's more at the Main Street business levels. Typically, the 20 million and up businesses are looking at, okay, I want to get out. I want to take money off the table. And that's what I'm seeing is, hey, I want the business to keep running. I still want to get money down the road too, but I want to take some money off the table and go to Costa Rica.
Wow, Costa Rica is an amazing country.
It is an amazing country. I love Costa Rica or Jamaica or somewhere. And Costa Rica is a really nice country, right, Sarah?
So overrated.
So I hope that helps, Dave. So what are the other thing I'm seeing is people are getting smarter about business when they start hitting those levels. They start understanding this, and I'm seeing some mergers. People start talking about mergers. Do you guys get involved in that?
Actually, we do. Our focus at the bank is mergers, acquisitions. Mergers, think of two companies combined, whether it's because of vertical merger, horizontal merger, or there's different ways where two companies come together. But yes, we are heavily involved in that. The process is all these processes with an investment banker are actually very similar on the way of collecting information, packaging it, going out to market, running the process from the beginning to the end. There's a lot of similarities, but yes, we are very involved with mergers. There's, a lot of people are doing roll-ups right now. There's a lot going on everywhere, and I'm sure everyone here is listening to the news and that there's a lot of money on the sideline right now. Yep. That they're looking to use it for things.
Well, a guy. Have you ever heard of Dave Packard?
Dave Packard,
as in Hewlett Packard. Dell. Oh, right.
I like Dell. Those are good computers.
Well, Dave once said that there's two ways to grow. You can grow organically, or you can grow by acquisition. And acquisition's a much faster way to go. And as I see these the world evolving, I see a lot more acquisitions happening over the next 3 to 5 years.
Right now, one of the key areas for private equity group, get that platform business, and then acquire all these companies, build that platform up, and as you're increasing them, those multiples, as we talked about, with all the systems and everything in place, keep going up, and then you sell it down the line. So that company, maybe you buy it for, we'll just say 5x EBITDA. Once it's part of this bigger company, it's now 7 times EBITDA, just because it's now part of this.
Right.
Instantly increase the value. And we're seeing that. We're seeing a lot of platform, acquire, roll up, make bigger, package, and then
so those private equity firms kind of pull it all together and then exit out themselves.
Yep.
Interesting. What about, when you're in the early stages and, you want to start up a business and you're not sure what to do and you need money, and how do you even get started with that?
Well, there's so many different ways to get money initially. We're not talking, you're not going to go to a private equity group. Their check size, you're probably looking for maybe $25,000. they want to write a check for 5, 10, 20, 50 million.
Okay.
You're not going to go to that venture capitalist whose smallest check size is maybe 500,000.
Okay.
Or you might go to the angel investor. Maybe the angel investor works, that writes a $25,000 check. But there's also
but that angel investor, I mean, what are they going to want out of that?
Oh, they'll want a percentage of the company, or they'll just want to be your friend.
Really?
Yeah. Okay, maybe.
I would like to know some of those people that just want to be my friend.
Well, Joe, everyone wants to be your friend.
I've seen this a lot, especially here in Silicon Valley, where someone comes in and invests in the company, and then they don't necessarily give them enough to get to where they want to go, and then they have to get more money, and all of a sudden you're working for the investor versus the investor investing in your company.
I mean, the moment you take outside capital, you do have a boss. They want a return on their money. They'll want updates, whether it's quarterly, whether it's monthly, and they'll talk about it, or at least they would talk about it, the relationship, when they write you the check. These are the term sheets. This is the term sheet that's being offered. The term sheet will talk about it, what the relationship is, kind of what is being traded, the different, the equity. Is it a safe note? Is it a convertible note? All this and all those things. There's a lot of information online. There's a lot of experts you can go and talk to. We're not going to cover that today.
You mean there's some risk factor about taking money or getting somebody else involved?
Well, I mean, it's risk on both parties, right? It's the investor's risk that they may not get that return that they were expecting, and there's that risk on the entrepreneur that the company might fail. They're both taking a risk, but the idea is that it succeeds,
and they work together.
That money multiplies at a multiple that they're happy with. The investor maybe gets 2x, 10x, 100x, 1000x. That entrepreneur that puts in his time might also return 2x, 10x, 50x, 100x on his time and energy and what he invested. I mean, it's that relationship, risk reward dance.
Gotcha. So, if somebody really wanted to talk to you, what do they need to bring to you? What should they, say? How should they engage you?
Well, I mean, first it's that conversation of, Shawn, a year from now, we're really looking for some type of exit expansion event.
Okay.
And then I go, great. Tell me about your company. And maybe they don't send me the financials, but they have it in front of them that they can talk about. They have their financials. Mm-hmm. They have their team built out. They have maybe their advisory board or their board, all those things. They have their system in place where we know every dollar put in marketing, we get this return. We know the salespeople have these quotas, these KPIs that they're hitting. It's all pretty predictable. They have their goal. They know, everything that we talked about here and more, that they know that, and they're coming to us and they're saying, we're ready, we're at that stage, or what are we missing to get to where we want to be, or do you have any suggestions or that, and stuff like that. Normally go, hey, business coach, hey, lawyer, hey, accountant, hey, talk to these other experts that will take a look, patent expert, they'll give you some feedback, they'll give you some help, some strategy in this, and bump it up just a little bit for us. So earlier the better to have that conversation, to start cleaning up, getting things ready so that when it is time, it's successful.
Well, maybe we could provide our audience with kind of a list of prerequisites that they should have together before contacting you. Do you have anything like that?
I know someone who can send it out. Sarah, can you send it out to all our audience out there? Maybe just a nice little list of some things they should have on hand. It doesn't have to be before, but they should have it, around the same time that they're starting to engage with an investment banker or that, to have that conversation about the exit expansion.
Maybe we could call a preliminary information request.
That's a good name for it.
Well, thank you. I like that name.
Wow. Were you a theater minor as well?
So, you got to pull it all together. So I'm curious about one thing is, okay, before you really get to that, the data thing and going out and looking, I've heard the term LOI, and I think that means leverage operational input. No, letter of intent.
Oh, shit.
Letter of intent. Does that ring a bell with you?
So letter of intent. I mean, it's not a binding agreement, but it has that information, and it's normally laid out for the potential seller and the investment banker, so they kind of know structured what this one group is offering. So you can take that LOI and other LOIs when there's a process, there's multiple people competing,
right,
and have something to compare. You compare this to this to this to this. So you kind of see that, and or you have something to kind of look at to say, hey, let's go forward with this group or this group, because the highest offer might not always be the best with the terms, or the highest offer when looking at who's making that offer, you might go, this person, I don't have the confidence in that company to actually go through this whole process. They haven't done any acquisitions, whereas this company that made an offer, they've done 12 this last year. So when you're looking at the LOI, you're also taking that as some of the information of the whole, doing your due diligence on that person or on that group, talking with the client, giving kind of, hey, this is what we've done from our research. Maybe this is the one you should go with.
But I'm confused. When you sign an LOI, doesn't that mean you can't talk to anybody else?
Well, after the LOI, then we normally go into what's called a quiet period. And that could be 60 days. Sometimes they'll ask for 90 or maybe even more. Sometimes you negotiate down to less. But that quiet period gives us this group time to go into your data room, to do due diligence, to meet, check out the site, to ask questions that they need to write a definitive agreement, which is that statement that says, yes, we're offering this amount of money, this day, and it's got all the terms in the final agreement. But there is that quiet period. That quiet period, the company's not allowed to shop it around.
Okay.
Because it's expensive, this due diligence. You have lawyers looking, you have accountants, you have all these people looking at it.
You mean you charge money for this?
Whoa. Settle down there, MacGyver. It's an expensive process for a company to do due diligence on another company. They have, like I said, the lawyers' times, the accountant, all these professionals, there's time. They're getting paid to look at this information and decide, is it truthful? Do they believe in it? Do they have confidence in it? What other questions should they be asking? And they don't want the seller to be going to other people doing the same thing. And the seller also spending money this time, or this whole time as well. The seller is paying lawyers, accountants. Everyone is spending money. So this isn't the cheapest thing. Well, I don't want to say cheap. I do want to say money is spent in this process on both sides.
I would say money's invested. Because it's not. If you think it was, to me, spending money is kind of just throwing it away. But the process I've been through, it is an investment in both parties to invest the time, energy, and money to get to the best valuation they can get. And if they're not ready or they're not happy with that, they come back and we talk and start building their business some more. If they are ready, then they put together either the sell, the merger, whatever the exit strategy or plan is, working with a quality investment banker. So I want to back up a little bit and kind of maybe walk this whole thing through all the way. Is that okay?
Sure.
So I decide what I want to do. I build the business, and then I say, okay, I'm getting ready to exit. I give you a call, and you say, yeah, this looks pretty good. And then, do you sign an NDA or anything like that?
Well, there's a lot. Yes, we sign a mutual NDA or NDA with them because they're giving us all this confidential information. But at the same time, we're also giving them confidential information. Both sides are. We're telling them about all our proprietary information. Like, we're giving them these sheets, fill this out. There's a lot going on both sides. So yes, agreements are signed, engagement letters or offer is signed, where we're saying we will do all this for you, but it will cost you this amount. This is the retainer, this is the success fee. This is what you pay us now, and when this closes, this is what we would get
So that's all done. And then the LOI.
The LOI is after we've already gone out to market. We did all the marketing for it.
Okay. So you got the NDA with the client.
Okay, so we got the NDA with us. Then they start giving us all their information.
Right.
Then we start creating all the marketing material.
Gotcha.
After that, we go out to market. After going out to market, we start getting offers.
Right.
From those offers, we then send out. I didn't go into it, but a process letter saying these are the dates we need these things. We send out the process letter. They all know. Then they send us LOIs, letter of intent.
Right.
From that, we go to the seller or whoever and say which one. Pick that person. We go into the quiet period. They're going through the data room, doing due diligence there. Then everything is great. No hiccups, of course, right?
Oh, of course. I mean, everything's always clean, right?
Definitive agreement. They sign. This is what we're going to offer. Then it's smooth sailing after that.
And you can't do that in 30. You can't do that in 30 days.
Well, I mentioned scuba diving.
Oh, scuba diving.
Because it takes 2 weeks to plan scuba diving.
It does.
So you have to add that time.
If you don't know, I love scuba diving, so thank you. Yes, I look forward to it.
It might actually take a month to plan scuba diving.
Well, it depends on where we're going right now and what's open and what's not, too.
Good call.
So, kind of 6 to 9 months to go through that process. Once you've built the business and really starting to look at that options of moving forward, and or you need investment money that somebody's going to give you some money to expand or to buy another company or to go or take money off the table. Yep. What are some other things that could be used in that space that people come to you for your services?
Well, I mean, I'm not sure if we have time to go into everything, but advisory work, valuations, all that. But I mean, the bread and butter of what we do is mergers, acquisitions, raising growth capital, or a little bit of pre-IPO on the secondary. But back to the merger, acquisition, buy and sell side. So maybe a company comes to us and say, listen, we want to acquire companies. Please go out to the market, find us companies that we can acquire. We run the process again. But with that, Joe, tell me, who are some of your idea clients?
Well, my ideal client is when they're at that 3 to 5 million space and they're like, okay, now I really got to figure out where am I going? And my goal is to get them to that 20, 50 million so that they can exit in the most profitable manner that they want. So that's my favorite space, especially when they've gotten to this business and they're like, oh, I got here. What do I do next? Because a lot of business owners get to a place and they're not sure how they got there. And now they really need to put some systems, process, tools in place to move to that next level and get the highest valuation. So that's what when I love to get engaged. But I also believe in helping people. My goal every year is to help at least 2,000 businesses.
Well, Joe, we got to make that 3,000. But if someone wants your help, how do they go about it? Because, I mean, we only have so much time left.
So Sarah will send out some information on how to get in touch with me, set an appointment. Like I said, my goal is it should be
that's a nice QR code there.
There it is. So to schedule an appointment with me, take out your phone and just click right there, and you'll get an appointment. And Shawn, what about you?
If you're interested in contacting me, please scan that QR code, pop my LinkedIn, and if you want to email me, my email is right there. Please check out our website. You'll find out more of what we do. And, something else that people might want to know about, there's this gentleman, and we mentioned it earlier, it's going to be on a podcast that goes live next Wednesday morning. Everyone should listen to it. Do you know what that podcast is called?
I'm not sure, but I think you're going to tell me.
It's called the Silicon Valley Podcast with your host, Shawn Flynn, who's interviewed some of the biggest names in tech, including Jim McKelvey, co-founder of Square, Melanie Perkins, founder of Canva, and I have lined up David House.
Whoa!
Intel.
So if you haven't listened to your podcast, they are phenomenal. I'm a regular listener, so thank you. And thank you for joining us today. And look forward to the next time we can do this.
Sounds great, Joe.
Are there any questions? Sarah, I think you had a question that was sent in.
Yes, if nobody else has any questions. There's one in particular. So this sounds really nice, but what's the downside of investment money?
Oh God. Well, going back to, you then have, a boss. You then, it depends who you take the money from. Maybe it's a great relationship. Maybe it's not a great relationship. There's a lot to it. I mean, that process, it's time consuming. It takes bandwidth away from your business into this process. And it's a lot of hours. There's a lot of, there's positives and negatives to everything. If you want to know more about the negatives, because we are limited time, please contact me. I will talk about it. And we did cover, the positive. Well, actually, here we gave a pretty good balanced view for you to make your own opinions. So there is negatives and positives with everything. I mean, raising growth capital.
I'm going to jump in because I've seen this too many times where people spend more time and energy trying to get money than they do building their business. So my suggestion is always get more customers, build the business. It's a lot easier to get money when you have customers and your business is growing and building than when you have not much there.
Yeah.
So build the business, get it going. Give me a call if you're not sure. Any other questions? I'd like to thank you all, and especially you, Shawn.
I'd like to thank Joe, no middle name,
for your investing your time with us today. It's been an honor and privilege to see you. And Shawn, thank you. It's been an honor. How do you say goodbye?
Zaijian.
Thank you, Joe. Thank you, Shawn. Great information.